So there we are at a new all-time high. Gold is in the mode right now where the breakout is starting to run. We're going to be in for quite a ride to come in gold. I think it gets to 3,000 in pretty short order. So we'll see what happens. Two major scares recently in the stock market. Essentially, we had that triple whammy where there was the yen carry unwind, there was the Nvidia bubble beginning to unwind, and there was the curve steepening that knocked the S&P down to 5,100.
Prediction shows that gold will reach $3,000 in the near future. Recent challenges in the stock market, including the unwinding of the yen carry trade, a correction in Nvidia's stock, and yield curve steepening, led to a drop in the S&P 500 to 5,100. Additionally, the Federal Reserve has cut rates 21 times while the stock market was at an all-time high, with stocks historically rising 12 months after each cut. The speaker, Tony Greer, known for his expertise in energy markets, metals, and trading strategies, expresses concern over Kamala Harris being elected president, arguing it would be disastrous for the stock market, with the potential for the S&P 500 to drop 30%. They criticize her policies, particularly proposals like taxing unrealized gains, which they believe would lead to asset sell-offs and harm capitalism. In contrast, Tony believes the market is anticipating a Trump victory, viewing it as bullish for stocks, especially given his previous policies, which supported the economy and stock market. They expect lower gas and oil prices under Trump, but foresee potential dips in energy stocks before they recover. The speaker, Tony Greer, praises the Federal Reserve for managing expectations by setting a low bar on economic weakness, allowing room for positive surprises. They argue a recession occurred during the Biden administration, but went unrecognized. Despite the steepening yield curve and potential volatility, Tony believes the S&P 500 will stay stable as long as the economy holds, with rate cuts likely keeping both the economy and market resilient. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
Kamala Harris has got the same odds of being elected president with no track record and no policies whatsoever, almost other than sort of constrictive Soviet-style communist policies. So I think that would be an actual disaster for the stock market. I think the S&P could go down 30% if she gets elected. She's talking about running on a platform of, censorship and authoritarianism and taxing unrealized gains and things like that. And, if those even get a breath of air, that's an absolute disaster for the stock market, right? There's nothing to talk about. You just have to think about it, right? What are people going to do with the assets that they have if they're forced to pay taxes on unrealized gains? They're going to sell them. Nobody wants to pay all those taxes and have to worry about the math year in and year out. So that's a big hit to capitalism, if you ask me. And I don't think that the market believes that she's going to win, judging from the way that it's going to be behaving. I think the market probably sees the truth a little closer, that Donald Trump is probably a much clearer front runner, since the economy did great and the stock market did great while he was in office. And, he's going to do all the things that are probably good for the stock market, like drill, baby, drill, and keep interest rates low, and God knows what could happen with the S&P if he gets elected again. Obviously, everybody's just wondering if the margin of victory is going to be big enough to steal the election, or that's not going to be possible. So I think that the market's telegraphing a Trump victory. I think a Trump victory would be very bullish. I think it'll rock the oil market initially, because I do think gas prices and oil prices will come down under the Trump administration. But I think that the stocks are probably set up to do very well in terms of generating solid earnings and outperforming earnings. So I think that maybe in energy stocks, there's a dip that you can buy, and those stocks wind up doing well by the time the market gets back on its feet, kind of thing. So I feel like the Fed has done a great job managing expectations, and if they want to get ahead of any weakness that they're seeing in the economy, they may have already managed, the worst of the economy before our eyes, at least in terms of what kind of interest rate cuts we're expecting and how dovish the pivot has been. So since they're really good at managing expectations, I'm going to guess that they probably manage expectations lower, kind of beyond where they need to be on the economy, so that they're kind of upside surprises for the market to celebrate, and in my opinion, like, we had the recession, and it was like long ago when we had like those two negative quarters of GDP growth in a row during the Biden administration. And, that's what the bond market has historically called a recession. And we saw it. and it was over. And that's when everybody in the world and like economists were like, well, we can't really call that a recession, because it was a bad look for Biden. So the reality was the recession happened. The yield curve was inverted a long time ahead of it and a long time after it. And now that the yield curve is steepening again, that's been associated with volatility in the markets. And we've seen the volatility in the markets kind of living through the steepening. So that to me is, saying as long as the economy doesn't come completely undone from here, that the S&P might be able to hang in there, given a weaker economy and change in policy by the Fed towards easing. And if the Fed is going to address it with lower interest rates, the economy is going to stay on its feet, and so is the market. That's, I think, what they're trying to accomplish and probably what they'll get.
Tony Greer argues that the stock market often gets labeled as fully valued. However, they believe this mindset can put investors at a disadvantage, especially in a bull market, which can last much longer than expected. Despite economic challenges like fluctuating interest rates, the S&P 500 continues to perform well, and the speaker dismisses traditional valuation concerns, emphasizing that the market is built to withstand various economic conditions. The speaker, Tony Greer, emphasizes staying invested in gold due to the weakening of fiat currencies, viewing it as a safer bet. While silver is also a precious metal, it has become more of an industrial metal, especially in solar panels, and shouldn't be traded solely because gold is rising. They warn that silver is more volatile and unpredictable compared to gold. The speaker believes gold is supported by central banks and governments, whereas silver could see sudden drops, like falling to $15 an ounce without the same fundamental backing. Tony Greer observes that commodities, once heavily sold off, are now becoming well bid during a period of Fed easing and a weaker dollar. Many are still short on base metals and energy, expecting a recession. However, with both the Fed easing and China providing stimulus, the speaker believes the anticipated economic weakness is already priced in, such as oil dropping from $85 to $65. They argue that expecting further declines despite these actions may be misguided, as the market is already adjusting to central bank interventions. Let's dive into the interview.
The market is deciding the stock market is worth and putting a top number on that and saying, okay, it's not going to be worth any more because we're at this value level. Go ahead, but you're probably not going to make any money. You know what I mean? Like, you're probably not going to see things breaking out and be able to go with them and things like that because you're thinking the stock market is fully valued. And there you are putting yourself at a disadvantage in a bull market, which can go on way longer than anybody would ever believe, and that's what we're in the middle of now. So it's like, if the S&P is built to survive, all these economic trials and tribulations and higher rates and lower rates and this and that, it's doing just that. So I don't really have much use for valuation and things like that. May, especially if gold stays this strong. But to me, the game is about staying in gold because of the destruction of fiat currency. I mean, silver is obviously, a precious metal. It's very much, though, become an industrial metal as well, with the use in solar panels and things like that. So it's kind of a hybrid metal to me. If you want to trade silver, make sure you're trading it for the right reasons. If you're buying silver because gold is going up and you expect silver has to go up a like amount or on a similar trajectory, I would be very careful with that line of thinking. They're not the same exact commodity. They don't have the same characteristics. They don't have the same they don't really have the same players in the markets. So yeah, silver may go along for the ride because it's a precious metal, but I'm sticking with the gold trade, and silver is just kind of a noise, have kind of a noise cancellation policy because it really is a rich man's casino. And at any time during this bull run in precious metals, or say, let's put it this way, at any time during this never-ending bear raid on fiat currency, at no point would I expect the bottom to fall out of gold, whereas at no point would I be shocked at all if the bottom fell out of silver. While we're in this mode here where, we're running up our national debt, central banks are buying gold, the Saudis are trying to secretly buy gold. While we're in this positive flywheel for gold and precious metals, it wouldn't shock me if I woke up one morning and silver was $15 an ounce instead of 32, right? And everybody was like, oh my God, what happened? And like the answer would be like, of course that happened. It's not gold. It's not the same thing. It doesn't have the same support for it as the gold market. So, that's just one of my kind of philosophies, having been around trading those metals for my entire career. The big axe that I've had to grind in the last couple of weeks is that commodities are going from extremely offered and thrown out like the baby with the bathwater to they're morphing into a phase where they're going to be really well bid during a Fed easing period, a weak dollar period, and nobody is positioned for that right now. In fact, I think they're the other way, where there are still probably big shorts out there in a lot of base metals and in the energy space because everybody's expecting a recession. And now that we've got the Fed on an easing path to combat that and China on a stimulus path to combat that, if you're still looking for that, economic weakness to unfold, I think you're now looking in the wrong direction. Because it's getting the address that it needs from central banks, and the effect of expecting all of that weakness is already all over the tape. Oil went from 85 to 65 from June 1st to, the last couple of months. There is the economic divot priced in right there. So if you think that it's going further from there, even with China stimulus and U.S. easing, we need that view in the market so people can express an opposite view. But I don't think that view works out.
The speaker provides a comprehensive analysis of the financial landscape, emphasizing the current bullish outlook for gold amid fiat currency concerns and central bank interventions. They caution against over-reliance on silver and highlight the potential for market resilience despite challenges. Given the volatility in silver, what strategies could be effective for managing risk when investing in precious metals? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.